Ladies and gentlemen, welcome back to the channel. If you notice the audio is a little bit different here in today's video, well, that's because I forgot the mic. And yeah, we're way too far from home to get the mic. So we're just gonna have to deal with it. I hope the value provided is better than the audio that is also provided. Let's go ahead and get into what's going on with AMC stock today. AMC is down about 2.74%. This is a pretty rough day for AMC stock investors, and we'll talk about why. Hit the like button and subscribe to the channel, and let's get straight into it. So AMC stock is down to $6.56 per share. Rough day. Why I say this is a rough day is not just the 2.5% down move that we are seeing. It's actually because the broad markets doing pretty well, especially the Russell 2000. The Russell 2000 is up 0.62%. Even the NASDAQ is up 0.25%, and AMC stock is just getting kind of pummeled today. Relatively speaking, AMC's underperforming the markets like 500%. That's a pretty rough day. Now, I think at some point this will shift. But as of right now, it's not. Take a look at 10-year treasury yields. 10-year treasury yields on the decline again, down about 2.5 basis points to 3.89%. You would think at this point, AMC would be getting a benefit from rates going lower and capital coming back into our markets, because capital is coming back into our markets. Just last week, we had the highest inflows to the SPX, the S&P, that we have literally ever seen before. Okay, haven't seen anything like it. Now, let's go ahead and look. See if we can find it right here. The biggest inflow ever, over $20 billion that went into the S&P 500. The IWM also had some pretty big inflows as well over the past, couple of weeks or so. And it's just not feeding into AMC stock. I don't know exactly why. I don't know when this will shift. I still expect that it will shift at some point, but it just hasn't yet, and that's unfortunate. Now, there is some pretty good, data here to support the bull is still intact. One of these from Ryan Dietrich. He runs the Carson Group. He says lots of wild stats of strength the past few weeks. I have to say, might be my favorite. The Russell 2000 from a 52-week low to a high in only 48 days. Previous fastest ever, 60 days in August to October of 82. All it did was gain another 54% the next year back then. So it's the last time we've seen something this aggressive. The markets went on over the next 12 months to rally 54%. Because why? In 82, small caps were also depressed. 2022, small caps were also depressed. 2023 as well. Now 2024 is looking like it's going to be a lot better than what we've seen in the prior 2 years. A lot more capital flowing back into our markets. Now, if we take a look at the Fed rate monitor tool, take a look at probability for Fed policy by the end of 2024. We're still looking at 1, 2, 3, 4, 5, 6 rate cuts that are currently being priced in. The probability is actually going a little bit higher today. Probability of 6 rate cuts now sits at 37.4%. Yesterday, the odds were 37.3%. And the odds that we actually do get 7 rate cuts is increasing today quite a bit. Yesterday, the odds of 7 rate cuts was 23.2%. Today, the odds are 29.4%. So you're getting pretty close to pricing in 7 rate cuts in 2024. I believe that's a rate cut at every single Fed meeting, or pretty close to it. We have 1, 2, 3, 4, 5, 6, 7, 8 Fed meetings in 2024. So pricing in 6 rate cuts is pricing in a rate cut at almost every single Fed meeting. 7 rate cuts would be every meeting besides one, which right now we're expecting rate cuts basically at every meeting besides January, right? So right now we're not expecting a rate cut in January. We're expecting a cut in March, a cut in May, a cut in June, a cut in July, a cut in September, a cut in November, and a pause in December. So that would be a pretty aggressive rate path ahead. If you start to price in 7 cuts, you're probably just going to price in a cut at every meeting, including December of 2024. If you price in 8 rate cuts, then you're going to be pricing in either a rate cut in January, which does not look likely at this point, or you're going to start pricing in at least one Fed meeting to give you a 50 basis point rate cut. I don't know if that's going to be good at that point. That might be bad, right? We obviously have to see the economic data, how things do continue to evolve in the economy. But something you guys definitely want to be watching for. Now, one of the big stories in after hours, congratulations to the trading group or community that did hit this trade. FedEx shares tumbled 10% after weaker demand hit revenue outlook. This trade was $4 a piece into $85, $85 to $95 a piece. We had 50 of them. So yeah, that was thousands of dollars, $4,000 to $5,000 in profits that some of you guys made. That would cover the cost for the trading community for 16 and a half years. So definitely check out that group if you guys want to be a part of it. Nonetheless, what FedEx reported was not exactly great. Revenue was $22.17 billion versus $22.41 billion, which was expected. So revenue missed, earnings per share missed, and they said, quote, in the remainder of fiscal 2024, we expect revenue will continue to be pressured by volatile macroeconomic conditions, negatively affecting consumer demand for our services across our transportation companies, FedEx said in a filing, and its fiscal year ends May 31st. So you're so far into Q4 right now. You're almost over with Q4, and FedEx is reporting earnings for Q3. So FedEx has a pretty good idea of where numbers are going to be for Q4. It's literally almost over. So FedEx fell quite a bit. Those trades hit well. So congratulations to you guys in the trading community if you did hit that one. Nonetheless, other market news. You can see mortgage demand slips despite another drop in interest rates. Interest rates fell again, but mortgage demand was tepid last week, according to the Mortgage Bankers Association. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan 8.3% from 7.07%. The Mortgage Bankers Association also predicted good news ahead for the housing market despite expecting a mild recession in the first half of next year. Yikes. So not fantastic. 30-year mortgages were at 8% at one point. Now they're at 6.83%. So that's good, but it's just not enough to get people moving and selling. I think you really need to see rates at 5%. Probably around 4.5% to get people, excited for, to move and buy a new house to be able to afford that. And basically the way most of your mortgage pricing works is it's off of the 10-year treasury. And this is important, and I'll explain why. The 10-year treasury. So usually what happens is mortgage brokers, right, banks, they add about 3% to the 10-year treasury. So if the 10-year treasury is 3.90%, you add 3% to that, you're at 6.9%. That's pretty much exactly where 30-year 30-year mortgages are at right now, right? What did it say, 6.83% or something along those lines. So yeah, that's basically how it works. So to get a mortgage at 4%, you need to see 10-year treasury yields at like 1%. Or to get a 5% mortgage, you need to see 10-year treasury yields at like 2%. 2% seems a little bit more reasonable to actually get to. And now some brokers can, do 2% on top of the 10-year, but most of the time they go with 3%. and that's basically how they get paid, right? But that's pretty universal across the board. My mortgage broker told me that, and it seems to align with current rate of treasuries across the or of 30-year mortgages across the board. Now, why is that important? Well, if you are in the recession camp for next year, if you see treasuries continue to fall and people can start selling their homes and moving, you could free up a lot of equity in homes, and people could turn that money into the bank and spend more money. When real estate is not moving and people are not able to buy or sell their home, they have a lot of money sitting there in equity that they're really not spending, right? So as you do see more real estate transactions, taking place, that's going to give quite a few people a chunk of money, and you don't think they're going to spend more money in that scenario. So believe it or not, 10-year treasury yields continue to fall or continuing to fall can help spur the economy. Believe that or not, just by housing, by mortgages, right? A lot of people have equity, lots of equity in their homes. Now, let's get into a little bit of what's going on here with AMC. Let's look at the data. You do have short interest of free float at 8.8%, $146.74 million worth of short positions currently in AMC stock. Days to cover 1.08, 21.77 million shares that are currently sold short. Shares out on loan 14.5 for 12.45 million. Cost to borrow 1.18%, utilization of 21.23%, and a short score of 49.73 out of 100. Cost to borrow numbers about 1% across the board. Nothing exciting at all here. We don't have any option statistics today for hedge fund and institutional trades. But if you take a look at the call side, you have volume of 73% to the calls, 27% to the puts. So, over a 2-to-1 ratio, basically a 3-to-1 ratio, as 3 times as many calls being bought for every one put. So it looks good, but AMC stock just cannot catch a break here. You do have calls in the money currently at about 12,000, calls out the money 88,000, puts in the money about 15,000, puts out the money at about 34,000. So a decent amount of option activity here on the chain as well. We do have some data coming out tomorrow that will be important, as well as on Friday. We'll break that down a little bit more in the next video. But that's going to do it for this one. Again, AMC stock just continues to kind of get beaten down here, and it's not a great sign. Although I do think the markets are quite overbought. You could make the argument it's justifiably so, but when you're this overbought, when the RSI is at 82 on the SPY, SPX, you're going to fall, right? You're going to consolidate. You're going to trade sideways in some form or another. So just be careful if you have a lot of bullish. If, the markets stop running here, you're going to get destroyed pretty dang quickly. So just want to let you guys know, be a little bit careful right now. If we do get a slight pullback, consolidation phase, that's maybe where you can go in a little bit bigger with your trades, because I think justifiably, fundamentally so, stocks are probably going higher from here. And I think higher, dramatically higher, especially small cap. So let me know what you guys think about all of this information down below in the comment section. Again, I do apologize for the quality of the audio. It is one of those tough situations. It will be fixed coming tomorrow. But hey, I hope you guys get more value out of this video than the audio takes away from this video. Hit that like button. Again, subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.